Ladies and gentlemen, if you think the future of money is going to look anything like the past decade, think again. What I'm about to share isn't speculation, it's the cold, hard reality of history, economics, and human behavior. Most people have absolutely no idea what's coming for gold and silver, and that ignorance will cost them dearly. Right now, the majority of investors are focused on short-term noise, daily price swings, headlines, social media opinions, while missing the structural shifts happening beneath the surface. When you step back and look at the data instead of the drama, a very clear picture emerges. Governments globally are carrying record debt levels. Central banks are trapped in policy cycles, and fiat currencies are being diluted faster than most people realize. That combination doesn't collapse overnight, but it creates pressure that builds quietly, then releases suddenly. And historically, when that pressure releases, capital flows towards safety, assets that cannot be printed, manipulated, or politically engineered. Over the last several years, monetary policy has become reactive rather than strategic. Every slowdown, every crisis, every shock is met with bam, the more liquidity, lower real rates, and expanding balance sheets. That keeps markets afloat in the short term, but it steadily weakens the purchasing power of currency over time. Investors often don't notice because inflation moves unevenly. It doesn't show up everywhere at once, it leaks into assets first, then commodities, then necessities. By the time the average person feels it, the repricing has already happened. When currencies weaken, money doesn't disappear, it migrates. Capital rotates away from paper promises and toward tangible stores of value. That's why throughout history, when confidence in monetary systems fades, metals begin to behave differently from risk assets. They stop trading like speculative vehicles and start acting like protection mechanisms. This shift is subtle at first. Volume increases quietly. Volatility compresses before expanding. Smart money positions early while the crowd remains distracted by equities and crypto narratives. What's important to understand is the difference between hype and structure. Structural moves don't explode overnight. They form bases, they digest, they frustrate impatient traders. Then, when conditions align, they accept. Right now, gold and silver are not reacting emotionally. They are responding technically to long-term imbalances in debt and currency valuation. That's the part most people overlook. They expect fireworks before the foundation is built, but markets build before they launch. Another critical factor is real interest rates. Nominal rates may rise, but if inflation runs hotter, real yields remain suppressed. That environment historically favors hard assets. When holding cash guarantees a loss of purchasing power, investors begin searching for assets that preserve value rather than merely promise it. This isn't speculation, it's capital preservation behavior. Institutions don't chase returns first, they protect capital first. And when protection becomes the priority, flows quietly begin reallocating. Silver adds another dimension to this equation because it sits at the intersection of monetary metal and industrial necessity. When global systems come under strain, investors seek it for protection while industry still requires it for production, energy, technology, infrastructure. That creates a dual demand profile. Supply, meanwhile, is not elastic. You can't print metal. You can't scale mining overnight. When investment demand and industrial demand overlap, pressure builds beneath price without needing public enthusiasm. From a technical standpoint, markets telegraph their intentions before they move. Long consolidations, tightening ranges, failed breakdowns, and higher lows are not random, they're accumulation characteristics. Large participants don't buy tops. They build positions quietly when volatility compresses and sentiment is neutral or negative. When you see metals refusing to collapse during broader market uncertainty, that's information. It tells you capital is no longer abandoning the space, it's starting to respect it. Most retail investors wait for confirmation from the media. That's usually the worst moment to act. By the time headlines are praising metals, the structural move is already well advanced. Professionals focus on probability, not prediction. The probability improves when debt expands faster than productivity, when currencies lose purchasing power faster than wages rise, and when geopolitical and financial risk remains unresolved. Those conditions are not temporary, they're systemic. This is why preparation matters more than and excitement. Gold and silver are not lottery tickets. They're strategic positioning tools. They function best when nobody is emotional about them. The biggest opportunities emerge when assets are boring, misunderstood, or ignored. That's when risk to reward quietly shifts in your favor. What's coming is not chaos, it's repricing. Markets don't destroy wealth instantly. They revalue it. They move purchasing power from one asset class to another. Those who understand the rotation prepare early. Those who wait pay higher prices for the same protection. The key is not fear, it's awareness. When you analyze the system instead of the noise, you realize something important. The foundation is already changing, whether the crowd sees it yet or not. Most investors spend their time reacting instead of positioning. They wait for confirmation, headlines, and emotional cues before making decisions. But markets don't reward reaction, they reward preparation. If you study historical cycles, the biggest shifts in capital happen quietly, long before the public narrative changes. By the time the average participant becomes excited or afraid, the structural move is already well underway. That's now why understanding where risk is forming matters more than predicting exact price levels. Right now, global markets are operating inside a distortion created by years of stimulus, leverage, and artificial stability. Asset prices have been supported not by organic growth, but by policy intervention. That support works until it doesn't. And when it stops working, capital doesn't evaporate. It reallocates. It searches for areas where risk is lower relative to reward. This process is mechanical, not emotional. One of the most misunderstood aspects of metals is timing. People assume you buy after a breakout, after excitement, after price is already moving. But sustainable trends begin when participation is low and conviction is weak. That's when markets are absorbing supply, not chasing demand. Price stalls, compresses, and frustrates both bulls and bears. That's not indecision, that's positioning. Big money doesn't need excitement. It needs liquidity and patience. Volatility tells the real story. When markets prepare for expansion, volatility contracts first like a spring being compressed. Energy builds quietly. Metals historically follow that pattern before major directional move. Instead of exploding immediately, they coil. This is where most people get bored and leave. But boredom is often the environment where probability starts shifting. Another element many overlook is correlation. When assets that normally move together begin to decouple, something is changing beneath the surface. If equities become unstable while metals stop falling, that's not coincidence, it signals that capital is hedging, not speculating. Gold and silver don't need optimism to rise. They need uncertainty, and uncertainty doesn't arrive with noise. It arrives with subtle divergences. Liquidity is another hidden driver. When central banks inject or withdraw liquidity, it doesn't affect all markets equally. Metals historically respond later than equities, but when they do respond, they tend to trend longer and cleaner. That's because they're not driven by earnings expectations, they're driven by confidence in monetary systems. When that confidence erodes even slightly, metals begin behaving differently. Silver in particular reflects stress across both the financial and industrial layers of the economy. It's used in energy, electronics, and infrastructure, but it's also treated as money when systems wobble. That dual role creates asymmetry. If economic growth slows, monetary demand can rise. If growth accelerates, industrial demand supports price. Either way, downside becomes more limited when supply can't scale quickly. From a structural standpoint, markets are currently transitioning from expansion behavior to protection behavior. That doesn't mean collapse, it means rotation. Investors move from performance assets to preservation assets. You can see it in how capital starts favoring lower volatility, lower correlation, and tangible value. This is where metals naturally begin to gain relevance again, not because of hype, but because of function. Most people misunderstand risk. They think risk is volatility. In reality, risk is being positioned incorrectly when regimes change. A regime changes when the rules investors are used to stop working the same way. The playbook shifts from growth chasing to capital defense. When that happens, assets that were ignored become essential, and assets that were loved become fragile. The smart approach isn't trying to predict the exact top in stocks or the exact bottom in metals. It's about aligning with probability. Probability improves when price stabilizes while macro pressure increases. When metals stop responding negatively to bad news, it's a sign that sellers are exhausted and buyers are quietly accumulating. Preparation always beats emotion. Gold and silver are not about excitement, they're about structure, timing, and rotation. The opportunity doesn't appear when everyone agrees. It appears when markets quietly change character and most people don't notice yet. Markets don't announce regime shifts with sirens. They whisper them through compression, divergence, and capital behavior. Those who listen early position themselves calmly. Those who wait for noise enter late. And in financial markets, timing isn't everything, but it's often the difference between protection and regret. In every major market cycle, there comes a point where perception and reality begin to separate. Prices may still look stable on the surface, but underneath, the behavior of capital starts to change. This is the phase most investors miss because it doesn't feel dramatic. There's no panic, no euphoria, no obvious signal. Instead, you see hesitation in one area and resilience in another. That contrast is where, the opportunity begins forming, especially in assets that protect purchasing power rather than chase growth. For years, markets have been conditioned to believe that liquidity would always be available, that policy would always step in, and that risk could be absorbed endlessly. That belief creates complacency. When investors feel protected, they stop pricing risk properly. They extend leverage, compress spreads, and accept lower compensation for uncertainty. But no system can suppress risk forever. Eventually, volatility resurfaces. And when it does, it forces capital to rethink where safety actually exists. Metals behave differently from traditional assets because they are not dependent on earnings, balance sheets, or political stability. They respond to confidence. When confidence in financial systems weakens even slightly, gold and silver begin transitioning from passive assets into active hedges. That transition is rarely explosive at first. It's methodical. Price stops making lower lows. Selling pressure fades. Rallies become more controlled rather than emotional. These are characteristics of accumulation, not speculation. One of the most important signals professionals work with, is how an asset reacts to bad news. If negative data no longer pushes price significantly lower, that tells you supply is drying up. Sellers have already acted. What remains are patient participants with longer time horizons. In metals, this often happens while mainstream attention remains elsewhere, focused on equity performance, technology stories, or currency debates, not on protection. Another piece of the puzzle is global synchronization. When multiple economies face similar pressures, debt, inflation, slowing growth, political friction, the need for a neutral store of value increases. Gold and silver don't belong to any one country. They're not someone else's liability. That's a powerful quality when trust between systems erodes. Silver's behavior is especially informative because it straddles the financial and industrial worlds. When manufacturing slows, investment demand often rises. When growth accelerates, industrial demand supports price. This creates a floor effect over time. Mining is slow, capital-intensive, and sensitive to price. That lack of flexibility makes silver structurally different from financial assets that can expand endlessly through leverage. Conceptually, markets reveal intent before action. Long sideways ranges, repeated support tests, shrinking volatility, and higher reaction lows all show that participants are defending price, not abandoning it. These are not emotional buyers, they're strategic ones. They don't chase breakouts, they accumulate weakness. That's why the most important moves begin when price looks boring. Retail traders often confuse inactivity with risk. They assume if something isn't moving, it isn't working. In reality, consolidation is where risk is transferred from impatient holders to committed ones. The longer price holds a level under pressure, the more meaningful the next move becomes. Metals are currently behaving more like bases than tops, and that changes the probability profile. Another element is currency pressure. As purchasing power erodes unevenly across regions, global investors start seeking assets that behave consistently regardless of policy. Gold and silver don't depend on fiscal promises. They don't need growth to function. They only need stability in physical demand and uncertainty in monetary policy. That's why they historically outperform during periods when policy tools lose effectiveness. Markets move in regimes. Sometimes performance is rewarded. Sometimes preservation is rewarded. The shift between those regimes is subtle and slow, then sudden and obvious. Most investors only react after the obvious phase begins. But the positioning happens earlier during confusion, boredom, and disbelief. What's happening now is less about price and more about behavior. Metals are transitioning from ignored to relevant. That doesn't mean parabolic moves tomorrow. It means probability is slowly improving for sustained trends instead of short bursts. And sustained trends are where real wealth preservation occurs. The real mistake isn't missing a spike, it's ignoring a transition. Gold and silver don't need excitement to matter. They need a system that becomes less predictable. When predictability fades, protection rises in importance. Preparation is not dramatic. It's quiet. It's analytical. It's patient. Markets don't reward the loudest participants. They reward the ones who understand when character is changing. And right now, the character beneath metals is shifting from reactive to resilient long before most people are paying attention. Markets move in cycle. And every cycle eventually forces investors to rethink what they believe is safe. During long expansions, capital chases growth, performance, and leverage. People grow comfortable with risk because recent history convinces them that pullbacks are temporary and recoveries are guaranteed. But no environment stays permanent. At some point, the same strategies that once worked begin delivering diminishing results, and that's when capital quietly starts changing behavior. The shift never starts with panic. It starts with efficiency. Institutions begin reducing exposure to assets that carry rising volatility relative to reward. They don't need headlines to do this. They measure it through price stability, correlation shifts, and liquidity flow. When volatility increases while upside becomes limited, smart capital stops pressing risk and starts reallocating towards stability. Gold and silver are not growth instruments, they are stability instruments. They perform best when investors are less confident in forecasting outcomes. When economic paths become unclear, preserving purchasing power becomes more important than maximizing returns. That's a psychological shift as much as a financial one. One of the biggest misconceptions is thinking metals require a crisis to perform. They don't. They require uncertainty and declining trust in monetary efficiency. When central banks lose precision, when debt grows faster than productivity, and when policy responses become repetitive, markets begin pricing in structural risk. That risk isn't visible in a single data point, it shows up in behavior. Shorter rallies, deeper retracements, and rising hedging activity. From a technical perspective, price structure matters more than opinions. Long-term basing, declining downside momentum, and repeated defense of key levels signal that participants are no longer distributing, they're absorbing. Absorption is what happens before expansion. Sellers meet bids and price doesn't fall. That tells you demand is quietly replacing supply. In metals, this phase is often ignored. Money doesn't sit still, it searches for efficiency. When yields compress, currencies fluctuate, and equities become crowded, capital seeks assets with lower correlation. Gold and silver naturally fit that role. They don't rely on corporate growth or government performance. They rely on scarcity and trust and fee, cycle value. Silver's importance grows in environments where technology and infrastructure demand remains present while monetary hedging increases. Energy transition, electronics, and industrial systems require silver regardless of financial cycles. That creates baseline demand even when economic momentum slows. Combine that with investment interest and you get a pressure system forming under price. Most investors want excitement. They want fast moves and emotional confirmation. But the best positioning environments are quiet. They feel uncomfortable because nothing is obvious yet. That's precisely when probability starts shifting. When metals stop reacting negatively to broader market stress, it suggests capital is testing them as a defensive allocation. Another mistake people make is treating gold and silver like trades instead of strategies. Trades look for timing perfection. Strategies look for regime alignment. A regime is the environment that determines which assets get rewarded. And right now, that regime is quietly but unmistakably changing.